I want to welcome everyone to Chatham County Cooperative Extension's Farm Tax Webinar. Tonight, we're going to be talking about Schedule F expenses, and I'm going to hand it over to Guido Vanderhoven. Thank you, Guido.
Thank you, Debbie, and good evening, everybody from warm and sunny Lawrence, Kansas. Debbie, is the audio sufficient?
Yep, you sound great.
Wonderful. So as Debbie said, tonight we're going to talk about Schedule F expenses, the farm expenses, and we're going to go line by line, very similar to what we did on Monday evening. The reason it may go a little long is that we've got more lines and maybe a little bit more discussion. And this is generally where folks do have some questions about, well, can I include this here or can I include that there? And we'll just go through with it. I will pause, as Debbie said. I've got 4 places in the 3 in the inside the presentation and then 1 at that very end. So if folks have questions, and we want to make sure that those questions would be pertinent to what I've just finished discussing. Hopefully the question that or document that we had talked a little bit about on Monday evening was emailed out, and that's going to be hopefully a useful tool to you. So what we're going to look at tonight, again, is just that this is going to hopefully be a discussion of Schedule F, specifically focusing on the expenses of farming or ranching businesses. And my focus, again, is going to be on the cash method of accounting, where a great majority, a little over 98.5% of American farms use the cash method of accounting, and we're going to go line by line, as we've said. So why don't we get started? So the first line is going to be car and truck expenses, and there were several questions that came up in that document looking at how do I do that. So let's kind of look at line 10. So this is where we report the expenses of car that we use in our cars and light pickups in our respective farm businesses. Now, there are a couple of ways to do that. One is obviously actual business expenses can be deducted as allocated to the expense, but we're going to have substantiation provided through whatever record keeping system that you're doing. So that would be our depreciation, our fuel changes, etc., those kind of things. Now, alternatively to that, IRS has what's called the standard mileage rate, or SMR, and that can be used, and it's a simplified method. It's for 2023, it's 65.5 cents per mile. And then for 2024, as you can see there, the SMR did increase a little bit to 67 cents. Now, as part of that value per mile, 28 cents in 2023 is a depreciation component, and 30 cents per mile is the depreciation component for 2024. And that is important to keep track of. If one ever disposes or sells the vehicle, then we want to get a hold of that question. Now, broadly, mileage logs are going to be required. But having said that, and because we're talking about taxes, there is a temporary Treasury regulation that's been around for about 40 years. So I'm not so sure it's temporary, but it actually is designated within the Treasury regulations as being temporary. And it does allow farmers, and again, I'm not going to define farmers again, but we've talked about that in the past 2 webinars. But if we qualify as a farmer, then we can deduct 75% of the auto and truck expenses without mileage records. But we still got to have some kind of record to kind of figure out, well, what was 75% one way or the other. But that's a little bit of a safe harbor, but we're still going to do it. So let's take a look at some examples. Now, here's an example, and it just happened to be that it ended up being 75%. I guess I wasn't thinking very clearly when I ginned up this example. But here we got Jeremy. He's got a 3/4 ton pickup, and he uses it both for personal and business. And he keeps a mileage log over the course of the year. And it just happens that it does document that 75% of his mileage is actually going to be business miles. And you can see that in that little box at the lower left, where we got total miles of 40,000 miles, and then business miles per the log were 30,000. So that's where we get our 75%. Therefore, 75% of all of his actual expenses are going to be allowed to be deducted on Schedule F. And so we see his annual cost there in the middle column of that little chart: fuel at 7,600, repairs at 1,500, etc. So his total cost was $20,870 for this particular vehicle in this particular year. 75% of that is going to be allowed to be deducted. And so we see that as $15,652.50. Well, we're just going to round it up to 15,653 if we go all the way through with that. So what we do here, though, is we're going to report that actually on two different lines. So the allowable car expenses, we'll see that it's going to be $7,013. That's going to be 75% of fuel, repairs, miscellaneous. But you'll see that the depreciation is going to be down there on line 14 as a separate number. But if we add those two numbers together, they should be 15,653 on that amount. So there is record keeping. We don't want to just pull a number out of the air, although I know that it's done. Now, here is Jeremy again, looking at and utilizing the standard mileage rate, which is a little bit easier. Now, what he's done here is he's purchased a new crew cab pickup. And when you bring in a new vehicle, such as a car or a pickup, into the business, then you have an opportunity to go ahead and make this choice. Now, he does this, he says, I'm going to simplify my record keeping. I'm going to use the standard mileage rate. And it happens to be the third vehicle that he owns that's being utilized in the business. You can use the standard mileage rate all the way up on each vehicle as long as you have 5 vehicles or less. If you have more than 5 vehicles that are being used in the business, then you're required to use actual expenses. So anyway, he keeps a mileage log. He documents that he has driven 22,500 miles for business. And he's also paid $150 in tolls for business purposes. And so what he has is $14,888 as his expense for the use of this pickup on line 10. And it's illustrated there in that little screenshot of Schedule F. And you can see the calculation that this is a 2023 year, because that's the tax return year that's being filed right now. So it's 22,500 times 65.5 cents. And we add the $150 for those tolls, and that's how we get that number. A little easier. I use this when I do my father's income tax return, because he just finds that this is a heck of a lot easier than keeping up with all those other receipts and stuff. Then on Schedule F, there are several what I would refer to as self-explanatory lines. This would be lines 11, 18, 19, 26, 27, 28, and 31, as you can see on the screen. So line 11 is for chemicals. Line 18 is freight and trucking. Line 19 is gasoline, fuel, and oil, anything that basically are liquid or gas energy supplies that are being utilized by the farm. Seeds and plants, storage and warehousing supplies, and vet breeding and those kind of medicine for livestock health costs. Those are, when you look at the line descriptions, when you look at the instructions for filling out Schedule F, they're very simple and basically you can look at it and say, yep, I can understand. That's really straightforward. And so here is just an illustration of how these self-explanatory lines might work as we go through. You can see there $40,000 for chemicals, so that's going to be for the pesticides, which could be insecticide, herbicide. There could be a rodenticide, whatever is being utilized. Freight and trucking. So if it's billed out separately and you want to keep track of that, then you would deduct that currently. If a piece of machinery was delivered to your farm and you got an invoice that had, okay, here's what the machine cost, here's what delivery charge cost, you may want to pull that freight and trucking out because you get a current expense on that in the current for the tax year in which it was delivered and placed into service. Gasoline, all those others, as you can see there, I think that's fairly straightforward, but your record keeping system will bring those together for all 12 months, and then you get your annual total, and then you're going to just put your annual totals in on those lines. Now, conservation expenses, and there's a couple of questions that came in, and I tried to answer those. One of the things to think about, and this is relative to soil and water conservation practices. These are going to be, you might remember on Monday's presentation, I said there's a 25% gross income limitation for Code Section 175. Now, when you go into the code, it lists what you see on the screen. And these are the items. These are what are going to be considered conservation plan expenses for the purposes of Code Section 175. Earth moving, for leveling, grading, terracing, etc. There could be construction of diversion channels, drainage ditches, irrigation ditches. Those are very common that we would see, particularly in the eastern part of North Carolina, where we get out into the coastal plain. It's not to say that we don't have these kind of items in the Piedmont or maybe in the mountains. We would definitely might see more terracing in the Piedmont or in the mountains. If you're building some dams or some ponds for water conservation purposes, looking at waterway outlets, those kind of things. Now, the eradication of brush, so this is the recovery of pasture or field borders. And the reason I put that there is because that is an act of, well, we want to get that back into better permanent cover. We want to make sure that the land along the field borders is going to be as productive as it can be, realizing that, yes, between a pasture and the forest or the pasture and some cropland, we may have a little area there that we've got some stuff, but the eradication of brush, that is a little different than going in and clear cutting some forest land or some timbered land and then converting it to pasture. That expense, where we are clearing and that's land preparation, and that expense actually gets capitalized into the basis of the land. It's not considered to be a soil and water type of activity for conservation purposes. And the code is pretty explicit about that. And, if there is some cost share that comes, as we talked about last on Monday evening, looking at that's going to be an income source, but here we get to write that off, but it's going to be written off subject to 25% of the gross limitation. If we don't recover it all in the year that it's current, then what we end up doing is that we're going to have a carryover, and we can bring it back in and part of the calculation in the subsequent year. So again, records and some notations in the farm accounting system to say, hey, we did that. Planning of windbreaks, and then meeting the needs of any site-specific management action. And there have been several different programs over my tenure in North Carolina that looked at this, and some were actually pursuant to the Endangered Species Act. You might remember the red-cockaded woodpecker that was doing some forestry, and they were trying, but it was an endangered bird, and so they couldn't do it. But anyway, something to mitigate and something to manage those recovery plans for those particular species. So here we've got just an example. This is in the Low Country. I'm actually using one of my former students' name here that I worked with, but Reggie lives in the Low Country and he implements a soil and water conservation plan, as you can see there. Now it's to manage spring flooding and to protect the water resources, not only for the farm itself, but also downstream for other municipalities. His conservation plan has been approved. not only by NRCS, but also by the Department of Environmental Quality. He received $65,000 in cost share to implement the plan. He actually spends $92,000 and he completes the plan. So due to the 25% limitation of all of this, he got some cost share, didn't pay for all of it, but he's going to be limited. So Reggie is only going to be able to currently deduct $81,250, as you can see illustrated there in the box for line 12. And I calculated that by 325,000, which is the gross income, which you can see in box 9 times 25%, and that's that limitation. And then the balance, which is going to be the 10,750, if I've done my math right, then that's going to be carried forward. So assuming that this is a 2023 return, he's going to be able to deduct 81,000 currently, carry over 10,750 to 2024. There'll be some notation in his farm records to that effect. And then all things being equal, he'll be able to deduct the 10,750 in 2024, thus recovering 100% of this soil and water conservation plan practice that he implemented in 2023. So we talked yet last Monday again about custom hire or some of the stuff that folks did, and that was on the income side. There was a brief mention in one of my examples about maybe what would happen on the custom hire side for the payor. Well, here's where we're really going to focus on the payor of these. So custom hire is defined to be an expense incurred when the farmer or rancher hires a contractor to complete work needed on the farm or ranch. Now, this is going to be an independent individual that comes in. They're not an employee, typically. They wouldn't be an employee. They're just an independent contractor. And we're going to use line 13. And you can see there that it's custom hire, or there's a parenthetical there, machine work. So bringing in dozers, backhoes, whatever might be needed. The example here is that Sydney hires a custom harvest crew to combine her wheat. This is what we talked about. Even though Sydney has a combine, she can't cover all the planted acres in a timely manner. She wants to keep the landlords happy, and so she hires this custom crew. And as you can see here, she's paid the custom crew $25,000 for their services. And assuming that the contractor is not incorporated, then she's going to have to issue a 1099 NEC because it was, number one, in excess of $600, and number two, it's an unincorporated business entity. It could be an LLC, it could be a partnership, or it could be another individual that has this as their business. So that's our first pause. Are there any questions?
Yes, Guido, we do have some. Let me expand this so I can read these better. 1 second.
No worries.
Okay, we got a few. Do all gas receipts need to be kept, or can business mileage be tracked and then apply a yearly average gas cost rate?
Well, if you're using actual records, IRS will probably want to see those receipts in an audit. Now, one way to get around that is to use a credit card consistently for those kind of purposes, and then at the end of the year, request an annual statement, and then you'll have all of those payments for that gas. And that's, if you have a Shell card or an Exxon card or whatever, and you consistently use that, all as much as you can all the time, then that would be one way to get around it. To the question specifically, could you use an average cost? Well, you could. How did you determine that average cost? Was it the price of gas on January and then the price of gas on December 31st, and you take that average? That one I think is a little fraught with some error in there. As we all see, gas prices can move daily. But over the course of time, you can come up with some, if you keep track of those records to find that average cost sufficiently over time, whether if you do it once a week and say, okay, my average cost this week was, $3 and a nickel. Next week, it's $2.79, and you've got 52 prices. Then it goes down to who's across the table from you in an audit situation. So I'm not saying no, but it is probably a least favored position from IRS's perspective. However, there's something called facts and circumstances. And if you can present the case and you have been consistent 1 year to the next with this method, and you can say, I bought it at the Quick Trip. I've always bought it at the Quick Trip, and I buy the gas, and here's the price on Monday of each week. You got 52 prices. Then the question is, how many gallons did you use? And so then well, I'll use the average miles per gallon on my pickup. Well, all of a sudden you're starting to have to keep track of about 3 or 4 data points in order to come up with this number. And then maybe just putting an envelope in the pickup is a better deal, just to throw in your receipts. And that's what I do personally. I have an envelope in the pickup, and about once every 2 weeks or so, I bring whatever receipts are there, and I put them in a big envelope here in my office. And at the end of the year, I may have, about 75 gas tickets. And I'll just sit there and total them up and get them done. But at the end of the day, be consistent, but also be, and it might be that you say, you know what, using the standard mileage rate just might be a whole lot easier.
Does the SMR include gasoline?
Yes, it does. Gasoline, oil changes, repairs, all of that, except for things like tolls. But it basically is a pretty close estimate of what the operating expenses are on a per mile basis. And IRS has a unit that does make those calculations. And sometimes when the price of gas significantly increases over a period of time, we may have a mid-year adjustment. And that's happened 3 times in my memory in the last 10 years.
If we use mileage, then we cannot expense maintenance and gas, right? And then they also ask, I guess we can do standard mileage versus actual expense, depends on the situation.
Correct. It's going to be once you put a vehicle in service, you have to make a choice. You will either use actual expenses, and then in my 2 illustrations, the first one was that we had some business use and we had some personal use, and personal use was only 25%. Therefore, you could deduct 75% of all of the actual expenses as defended by the mileage log. The second example was we put a new vehicle in service, and we elected at that point, because you make that election on each vehicle, as I said, until you get 6 vehicles, and then you have to use actual expenses on everything. But it is an election, and then, simplified 67 cents a mile, keep a mileage log. I went to Office Depot. I've got a mileage log sitting in my pickup, and it's easy peasy. It just is a habit that you have to develop. And at the end of the day, I know how many miles I've driven. I knew where I drove to and why I drove to that particular place.
Okay, so I'm got a few more questions. So if anybody has any other questions for this section, go ahead and put them in, please. Would the high tunnel construction kit for an NRCS high tunnel be a conservation expense?
Not for Section 175. It might be but more than likely, it's not going to qualify for conservation at all, but it's going to be able to be depreciated as a capital item. You will report the income, it'll offset. So if you got some cost share to put a high tunnel in and got $15,000 and you spent $20,000, you're going to report $15,000 worth of income in, and you're going to have a $20,000 expense out. And that'll be capitalized as an asset, and then you'll depreciate it. More likely use either Section 179 expensing or bonus depreciation.
So this is from a different person, very similar question, but just to clarify, in past years, when I received an NRCS grant, I placed my high tunnel, wildflower seeds, mulching as conservation expenses. Since that's what I received the conservation grant funds for, was this incorrect placement?
I'd have to look at the specific wording of the program under which the cost share was provided. At the end of the day, as long as you have reported the income and then deducted the expenses, if it was such that you were limited because of the 25% limitation, and it took you a year, 2 years, or 3 years to do it, you've recovered your cost. There's no harm, no foul. But what the person asking the question is saying, hey, there was mulch, there were some other things that came in. I'd have to have a little bit more detail for a more specific answer. But I think the bottom line is, was the grant money reported as taxable income? And then were those expenditures that came out of that for those purposes, were those deducted over the correct time? And if they were, we're doing well.
Okay. What is a gross farm income limitation?
Okay, so that's a statutory thing. In the case of soil and water conservation, which is what we've been talking about, the statute says that a farmer can deduct currently. So currently would mean for me 2023, because that's the tax year that's being prepared right now, could currently deduct soil and water conservation expenses up to 25% of gross farm income. So in my example, I had, I think, $325,000 as my gross farm income as reported on line 9, and then 25% of line 9 is your limitation. And so as long as the soil and water conservation expenses were less than 25% of whatever's on line 9, you're able to fully deduct it in the current year. If not, you have to carry the excess over into the subsequent year.
Okay. On line 13, custom hire, all those custom hires must also receive a 1099 if their fee was over $600, correct?
Yes, it'd be a 1099 NEC.
Right. Okay, not sure if there's time, but it'd be good to hear Guido comment on ag conservation easement income expenses as they relate to the Schedule F. Guess this is more income rather than expense, so I should have asked that on Monday, but if you want to, we do have a lot of farmers getting,
Yeah. Okay.
Easements, so.
All right. So if there's conservation easements, and I know that North Carolina at the state level has tried to put some money into funds on a regular basis to acquire development rights and then place a long-term permanent conservation easement. So that's going to be income. That's the sale of a land right, or one of the sticks in the bundles of property rights. And so that would be income coming in. It would be eligible for capital gain treatment on the gain portion, depending on how much basis is going to be affected, et cetera, et cetera, et cetera. If there are some costs involved with that, legal fees, some surveying cost. Who's paying for that? Is it the agency that's acquiring the conservation easement, or is it the farmer that owns the land? And it just depends on what side of the coin that is. It will be essentially a cost of sale. It will be able to reduce the gain on that sale. But ultimately, I think the guts of the question is, if I get money for a conservation easement, is it taxable? And the answer is most likely yes, but it's going to depend on how much basis is going to be able to be set against the sale of the conservation easement. Was there a partial sale and a partial charitable donation of a conservation easement? And those are becoming a little bit more popular because entities that hold those want to conserve as much land as they can, and there is an incentive to kind of work the math to see, okay, we can pay this much to you now, and then, you know, if you make a donation of 25%, then we get a little bit more money still in the pot, and also you get the opportunity to have a charitable deduction, which will offset the income that you got from the conservation easement. And it's it can be a complicated calculation, but that's kind of where it is. But that's about as much as I want to go into without going off into the weeds.
That's it for the questions. I just want to share a comment someone had made that the Miles IQ app is a great mileage tracker that you can find on your phone app store. So
Yeah.
Thank you for that. But thanks, Guido, for answering those questions.
Yeah, Miles IQ is good. You just have to be real careful with some of those, and that's a fair comment. That as many as smartphones we got, the mileage log has to be relatively specific for why did you go and who did you go see. I'm familiar with some of those apps where you would swipe right and it would be personal, and you swipe left, it would be business, and it uses the GPS tracker to figure out where you're going. Just telling one that it's business is not enough. You need to let them know where you're going, which the tracker can do. It can show you left from your home and then you went to Pittsburgh. But why did you go? Well, I went to go see Debbie Roos and drop off a soil sample box. That would be a business trip, and you got that. But without the purpose and who one might have seen, that's going to probably, with a hard-nosed auditor, fail. And IRS has come out with some directives in the last 18 months relative to that. And I know that some of the mileage apps are adjusting and trying to make that simple. All right, let's carry on. So here we're going to go and we're going to talk a little bit about depreciation, and I'm going to kind of visit with this, and then Debbie and I have already scheduled a focused webinar on depreciation for later this year. And she'll be sharing with that as we develop it, because depreciation is one that a lot of folks sometimes have a question about, and then how we use depreciation as a tool to manage whatever is the number. And there are several different methods we're listing here, and the first one is bonus depreciation. That comes under Code Section 168K. And this was part of the Tax Cuts and Jobs Act. However, under present law, it's going to sunset January 1 of 2027. We had 100% bonus depreciation. The presumption of the law was that the taxpayer was going to use bonus depreciation. And so basically they were able to write off 100% of whatever they bought with no limitations. And now it's starting to phase out. Last year, 2023, you could use 80% of the cost. So if you bought a $100,000 asset, you could use 80%, and you have to depreciate the remaining 20 over the appropriate recovery period. This year it's 60%. There is, and the House has passed and sent to the Senate a bill in which it would extend bonus depreciation until January 1 of 2026. So we'll just have to see what Congress does. It is absolutely just frustrating for tax practitioners who have this question over their head. There's another bill that's been proposed by Ways and Means or in Ways and Means to eliminate federal income tax on Social Security. And if that passes, that may impact tax returns that are being filed now. Both of these things are just right now a headache. I've had 2 emails today just relative to bonus, but bonus depreciation for 2024 is 60%. For 2023, it was 80%. We then have what's called the expense election or the Section 179 expensing, and that is subject to limitations up to $1 million, a little over $1 million, with investment limits and also with income limits, business income limits. You cannot create a loss with Section 179, but you can create a loss using bonus depreciation. So it's really a job to fully understand the options that are available. Generally, we have what's called MACRS, which is Modified Accelerated Cost Recovery System. That's the depreciation system that we use today. And for agricultural assets, you have 3, 5, 7, 10, 15, and 20-year recovery periods. So an example for a 3-year asset would be swine, so either a boar or a gilt. 5-year asset is going to be new agricultural equipment, dairy cows, or beef cows, goats, sheep. 7-year asset is going to be for used farming equipment. 10-year asset is going to be a single-purpose agricultural structure, such as a greenhouse or a finishing floor for swine or a poultry barn. 15-year asset is in land improvements. So that's kind of going to be kind of like terraces. Could also be wells, could be a pipe that's buried for irrigation purposes. A 20-year asset, an example of that is going to be a multi-purpose agricultural structure that one uses to store chemicals and store equipment and that sort of stuff. So you got several different things. Now, there's also the ADS system, and that can be used to lengthen recovery periods. So 3-year periods become 4, 5-year periods become 7, 10-year periods become 15, 7-year periods become 10, 15-year periods become 20, 20-year periods become 25. Why would we want to do that? Tax management. We don't want to get all of the depreciation today because we know that in 3, 4, 5 years, our business is going to grow and we're going to have income. So you might think about it as a way to defer a depreciation expense. And we use a separate supporting schedule. It's IRS Form 4562, where we report the annual depreciation deduction for the current year. And here's an example. And I know these are big numbers, but sometimes it just makes it a little easier to just illustrate. And just remember, as we talked about a week and a half ago, scale doesn't apply. If you're in a farm and you're generating $15,000 to $20,000 worth of gross income as a farmer, good on you. You can use the same things and the same rules. So here we've got an LLC. It's a Crops LLC. It operates a diversified farm, and in 2023, it purchased a new tractor for $175,000. Now, they also have $85,000 of depreciation, which is going to be allowable depreciation on these assets that had been purchased prior to 2023. So these are those assets that we bought, several years ago. They're still on the depreciation schedule. They still are being recovered, and we look at that. So if we assume that George does not elect out of bonus depreciation, remember it's 80%. So he's going to get $140,000. That's 80% of the $175,000 plus $85,000. That's going to be the depreciation that's coming forward from assets that were purchased prior to 2023. And then he's got $35,000 of remaining basis on that new tractor. And he's going to take maker's depreciation. It's going to be 5-year asset. And he's going to recover that $7,000 in the current year. So when we add those three values together, again, if I've done my math correctly, we have $232,000 of depreciation. Now, nobody writes a check to somebody called depreciation. This is what we would refer to as a non-cash cost. Yeah, folks have either purchased their assets, their tractor, or they borrowed money and then bought the tractor that way. But when we've come to the end, I want to, as a tax practitioner, I'm going to want to see, what did you pay for the tractor? What did you pay for the disc, for the trailer, for the pickup, whatever it is? I want to see that sales contract so that I can put it on the depreciation schedule at the correct value. Now, if he expensed the tractor, he's going to be able to recover all of that $175,000 instead of having to go and split it $140,000. So he would actually get a little bit more of a benefit. The question is that the smartest long-term thing to do? As somebody that's looked at farm management and over 35 or so years, one of the things I have a problem with bonus depreciation in Section 179, I think it encourages farm operators to overcapitalize their farms because they're letting the tax tail wag the business dog. They'll say, hey, I'm going to go buy a new pickup truck, or I'm going to go buy something. They don't need it per se, but they're chasing that tax deduction. And I think one needs to look at it. If for business efficiency purposes, that a newer, bigger machine, because the farm has grown, then by all means, it makes sense to go do it. But we need to think through, at least from my perspective, but we're talking about tax tonight. And so I also need to think about is, hey, let me use the tax rules to my advantage so that I don't pay as much tax as I could if I made a different decision. So here's just an illustration. You've got Maria. She constructs, in this particular case, a new greenhouse for her cut flower business. And she's got a $85,000 cost in that. Now, I'm illustrating here that she's making a decision that says, hey, I could depreciate that greenhouse over 10 years, but I don't want to for income tax purposes. What I want to do is I want to be able to feather that out a little bit more. So I'm going to take and elect ADS, the alternate depreciation system, as opposed to the general depreciation system. And I'm going to do it over 15 years. Now, she makes that election right here on Part 3 of Form 4797, as you can see illustrated. You got $85,000. You see the recovery period is 15, so that tells anybody that's looking at it that this is going to be the way we're going to do it. She'll do half-year convention, and it's going to be straight line to do that. And so we have $2,833 is going to be the amount for that particular asset. Now you'll notice up on line 17, just above that, that we've got maker's deductions for assets placed in service in tax year beginning before 2023. That's at 24,000, and that's part of that illustration that we've got there in the story. And so her total depreciation, Maria's total depreciation in this example is going to be $26,833. So I get that from the $2,833 plus the $24,000. And this, in my view, this is one place where the farmer, the business operator, and if they're doing using a tax practitioner, they need to have a conversation and see what makes the most sense. Communicate what those business goals are, because depreciation can help make or break that. The next line that we see on Schedule F is employee benefit programs. Might not apply to many folks on the call, but it's part of the line number, and we use it. So here we've got a corporation, and this is Dark Inc. They operate a mushroom farm. Dark subsidizes children's daycare for their employees who harvest, grade, and package. And the daycare operates from 6:30 to 6:30 at an independent facility, and Dark contributes $200 per employee. Dark's employees who participate pay the additional $400 a month. And this year, as you can see there in the story, that Dark had 5 employees. They were employed an average of 10 months. So we've got $10,000 in daycare benefits, and it is a benefit. It's part of the program. So Dark is going to use, in this example, line 15, as you can see illustrated there. And I'm just making the assumption that it's a subchapter S corporation. And so one would use an 1120S that says 1020. I got a goof there. It should be an 1120S, and Schedule F is going to be a supporting form or supporting documentation to that corporate income tax return. Line 15, again, just looking at this, just another example. Here we have an LLC where an individual, Susie, and her spouse operate. So it's going to be a partnership. We've got 2 individuals. So that's just a different entity type. They have 10 full-time employees. They have group accident and health care for the employees. The LLC pays for that. It's $85,000, as you can see in the story. Same place. We'll just take it off as a benefit program other than on line 23. And that's where you want to put that in there. So here's feed. This is line 16 on Schedule F as we're walking through the form. So farmers, we're going to get it. This is going to be our feed, our minerals, our vitamins for our livestock, and we're going to do that. The example here is that we've got Robert. He's got a commercial cow-calf herd. He's reported and spent $20,000 for these allowable items in this tax year, and then you go ahead and just put it there, as you can see. So an individual, I think one of the questions that came up on Monday night was that an individual was raising poultry and had large guard dogs for those poultry. So you're going to be able, in that case, the guard dogs they lived with the poultry 100% of the time, and they had a purpose to keep the fox and the coyotes and whatever other pests that might eat them away. And so you're going to have the poultry feed, but you're also now going to have the guard dog feed in there and be combined as a business expense, and you would deduct it on line 16 if that individual is on the form on the call tonight. I hope that is something they might want to think about. Now, the one thing we got to think about is that there could be feed that might not be deductible. And sometimes this happens at the end of the year. So this is just another corporation. We've got Everett Inc. raising heritage breeding hogs. It's a pasture based plan. In the winter, the corporation provides covered shelter, as you can see there. Now, here's the key. On November 1st, Everett Inc. issues a check for $10,000 to Tasty Livestock Feeds on its account, from which it makes draws as it picks up feed on a weekly basis. Weekly feed prices are determined by fluctuations in the market conditions. This is a deposit. It's not allowed as a deduction because there wasn't on a purchase of feed by a volume, whether it be in 100-pound sacks or 50-pound sacks, however many sacks, whatever. It was just a deposit on the account. Now, what could be allowed as a current deduction are going to be those weekly feed purchases for November and December based on the receipts and the respective then draws off of this $10,000 deposit for these weeks. And then again, I'm just illustrating this here as Schedule F is used as a supporting document for Form 1120. This is a C corporation in this particular example, and doing so helps the corporation report that it is the farmer and could benefit from the tax rule that are afforded the agricultural industry. So the takeaway point from this particular slide is not to make a deposit, but actually to buy a set quantity at a set unit price at a certain time. Fertilizers and lime is a common one, and this would be for fertilizer, lime, and any other soil amendments. They're allowed. They're going to be subject to Code Section 180. And typically, the code section, if you read it, says it's supposed to be amortized over a useful period. The thing is that I would guess that probably 99.9999% of the time, an annual election is made either knowingly or unknowingly by the farmer, and they can deduct the expenses by reporting that on Schedule F, line 17. And the example here is that Bonnie raises eggplant and squash varieties. She regularly conducts soil fertility, and she doesn't want to over-fertilize. This year, she supplied $35,000 of fertilizer and lime, and she chooses now to currently deduct this expense under Code Section 180 election by simply reporting the $35,000 expense on line 17 as illustrated here. Now, here's the other side. And I've had to use this a time or two with some of my former clients because creditors don't necessarily like to see losses or continuing losses on schedule on their business returns. And here's how we can think this thing through. And I'm just illustrating this. Again, it may not be applicable to many folks on the call, but this is part of what is a special thing for production agriculture and taxes. So he's got a diversified farm. He spent $100,000 on fertilizer and lime. And he's been doing this for years on average. And he typically makes that deduction and just reports it on line 17. But this year, because of adverse weather conditions, he's facing a loss due to no or low crop year. And one way to increase farm income is not to make the annual election to deduct all that fertilizer, but to capitalize it and then deduct it over 5 years. And so what he decides to do is he capitalizes and then amortizes his $100,000 expense and deducts $20,000 this year, thereby increasing his farm income by $80,000. And he's deferring his $80,000 to be taken ratably over the next 4 years. So his income is increased by 80 grand. And he doesn't have a farm loss. And because he doesn't have a farm loss, he may be able to take and have access to other income tax benefits, such as the earned income tax credit, if they've got some children that qualify, or he might not lose the standard deduction amount because of his filing status because of the loss. And so what you have, you just create an amortization table very similar to what one would think. So year 1, 2, 3, 4, 5, as you can see there, the deduction amount is going to be 20,000 because we're amortizing that. So the remaining amount in year one is going to be 80,000 all the way down, as you can see there. This would become part of the permanent record in the tax file so that you would say, not forget, hey, I want to take that next 20,000. You can't go in and once you've made the election to amortize, you're going to have to recover that cost over the 5-year period at $20,000 a year. You can't just change in year 3, for example, and write off the remaining 40,000. Now, I've said that this is an annual election. So what happens if next year it's a really good crop for Jacob? Well, he can make that election and write off the $100,000 of the current year, 2024 in this case, plus $20,000 from this year. So he'd have $120,000 as a deduction in the subsequent year. Hopefully that makes sense. So, second question period.
Well, I can definitely see, I'm definitely glad we're doing an entire webinar on depreciation later because we have a lot of questions on that. Looks like we still need a little clarification on it. I'm going to start with this question. Can you explain what depreciation is again in simpler terms and why it's a benefit? I haven't depreciated any chicken houses, irrigation, my greenhouse, or animals, and I'm on my 6th year.
Okay. So depreciation is essentially a cost recovery of a capital expenditure that either will wear out, rust out, or become obsolete. So the tax code allows one to recover that cost, whether it be your chicken house or whether it be your pump. Now, one hopes that the chicken house is going to last more than 10 years. So one might argue it's a little bit arbitrary. Well, it's a 10-year, but that's the way the code works. Now, I don't want you to lose heart who asked this question. And I'm just wanted to let you know that if you've not depreciated the items to which you were allowed to take some depreciation, you can play catch up using a form, and it's form 3115. It's entitled Change in Method of Accounting. And it allows you to play catch up from the year that you bought it and failed to take depreciation to where you are in the life, recalculate it. You take that depreciation value and take it as a deduction in the year you're making this adjustment. And then you would carry on from that year to recover the remaining part of the depreciation. It's a little bit of a complicated calculation. If you don't use a tax practitioner, you might want to go consult with one to make sure that that gets done correctly. The nice thing is, because you paid more tax than you should have in the past, there is no fee for this particular change. And it's what's referred to in the code as a check the box type of thing. You just tick the box that you're making a change to depreciation on 3115, calculate it on 3115, and then you take the deduction on Schedule F, and then you go forth and sin no more.
Thank you, Guido. Hopefully that was helpful to this person. Let's see. Hang on. I have some okay. Oh, I'm looking both at private and public messages here. If my accountant was not putting breeding cattle in as depreciable items, how can I ask them to begin now, given that mama cows are different ages?
Okay. Were those cows raised or were those cows purchased? Raised cows, as we talked about last time, you deduct the expenses of the raising of them. That's the feed, the pasture rent, veterinary expenses, et cetera, et cetera. And so your basis is zero. There's nothing to depreciate on a raised breeding animal. If, however, you have purchased cows or bulls or sheep or swine, breeding animals, then they are eligible for depreciation, either 3 or 5 year recovery. And it was just like the same one. If that's been an error, then you can use Form 3115 to correct that error and catch up. You would have to have herd records to kind of say, okay, well, that one I bought 3 years ago, that one I bought 2 years ago. So it's a combination of production records, knowing when you've bought those animals, as well as tax records when you place those animals into service.
Thank you. Wouldn't you rather take as much depreciation as soon as possible? Because I thought any unused depreciation above and beyond income would just keep carrying forward each year.
No, well, the answer to that question is it depends. If you've got a public job and you're earning $100,000 a year in your public job, then yes, you might want to use as much of the depreciation in the current year to offset your public job's tax implications, as long as you were operating a farm for business and it was a bona fide farm. Now, if you're operating a farm and it's your sole income source and things are just a little bit skinny, it just depends on where do you want to be. Don't forget that part of farm profits are also, the farm profits are going to be subject to self-employment tax, which is not only for retirement, but I view it a little bit more for disability purposes. It may not be the best disability insurance plan around, but it sure beats not having anything. And you have to have some current coverage for disability, and you have to have 40 quarters of coverage for long-term old age, or what we refer to as the retirement portion of Social Security. Each individual on this call will have a different viewpoint about how much tax to pay and how in relationship to self-employment tax or not. So it's real difficult for me to give an answer. You know, time value of money, sure. If you've got some other sources of income coming in, then you want to get as much of that available to you, that money available to you today than tomorrow. But the other side of the coin is if you're borrowing money, your creditor wants to see some profits. And one of those ways to do that is to manage your depreciation, to work with your tax practitioner or yourself and think through, what's my sweet spot? I can tell you that many years ago, I had a former client come in, and this was before the internet. We filled out the Social Security form for the estimate, and we mailed it off to Social Security. 6 weeks later, he storms into my office and he says to me, "You've been making mistakes on my tax returns." That's a wonderful way to start a conversation. What had happened was he got his thing back from Social Security and said that he was going to get $243 as his Social Security benefit. And he said that wouldn't even pay for his bad habits. Well, that's when I had to explain to him, Social Security calculation is kind of like a savings account. If you don't put money into it, you're not going to get anything out. And he had been somebody that had been expensing, buying equipment, prepaying, and driving down his tax bill to zero as often as he could. And since he was 55, he had about 10 years to figure out, and he became a happy taxpayer as we went forward. So again, the answer to that question is it really depends on what your viewpoint is and what other sources of income you've got coming into the return. Like I said, if you've got a public job and it's paying you good wages, then it makes sense to depreciate everything as fast as you can, because then you can get a bigger tax refund down the road. But if you're 100% full-time farmer, then it may not be that that is the best long-term item, because you're going to kick that can down the road, and there may not be any. If you become injured, what happens then? Do you have health insurance? Do you have disability insurance that you're paying for? And if you haven't, and if you're not currently covered with Social Security, you won't get any coverage. That's probably a little bit longer than what they wanted, but
All right, just as a heads up, Guido, we have lots of more questions here. I bought an agricultural spraying drone. Am I able to depreciate that for my personal farm use if I'm also depreciating it as a separate ag business?
no, it's either or. And if you're going to use it on one, if you bought it primarily for your service business, just leave it there on your service business, and then you're using it on your farm business. But you can't get a double goodie.
That's right. No double dipping. Now, these are kind of awkward when the questions are kind of referring to a slide that you were showing, but this one is, wouldn't the depreciation be 85,000 over 15 years, about 56,666 a year? 5,666,000 a year.
Well, it's mid-year convention, it's half-year convention, so I'm showing 2,300, and that's why we need to have a depreciation webinar. I can't cover depreciation in 5 minutes per slide.
That's correct. I know. And there's so many depreciation questions. And again, this is referring to one of the case studies. Is there a business benefit to paying those dark employees the same amount in additional wages versus covering part of their children's daycare?
It's all going to be deductible. It's just an illustration of where you would report that. So don't get lost in the, well, I don't want to get into daycare. I'm just going to give my people another $200 a month. That's fine. The problem is, and we're seeing this here in the Midwest, we can't get people to come work. So how do we differentiate ourselves as an employer to be competitive, to get good people and competent people? And employee benefits is one of those ways to do it.
Yep. I purchased my farm business in 2023. Can I deduct my down payment and monthly loan payments on the purchase as depreciation? The purchase included assets and a customer list, but not land. Okay.
So the assets, you would break the assets down as to what they are, and they're going to be recovered as per whatever recovery period is required. The customer list is going to be depreciated or amortized over 15 years. It's blue sky, it's goodwill. And so, yes, if you did not buy land, but you bought stuff, you're going to be able to recover that. Now, not entirely in the first year, but it just depends. If it was 2023 and the items were 80% a bonus depreciation for allowable stuff that you're going to be able to get, is that the smartest thing to do? Again, I don't know.
If a tractor, like in the example presented, was purchased for $175,000, is being paid off over time, what amount can be used for depreciation? The full value of the tractor at $175,000 or the 12 monthly payments made during 2023?
No, you start with 175,000. The loan is a totally different animal. The loan helps you buy the tractor. The tractor's purchase price was $175,000. That's your depreciation, and you want to match your loan to the asset that you're purchasing, its depreciation life. So the 12 payments that are made, that's going to be principal and interest. Principal is not deductible. The interest is.
Agritourism question. What if we own animals for agritourism purposes and we file a Schedule C as well for that? Can animal feed still remain here in Schedule F?
if they have a farming business, yes. If it's strictly a Schedule C agritourism business, then feed would be deductible as an other expense. And then if they've got livestock that they're purchasing just to have as part of a petting zoo, then those are going to be depreciated over the life. It just is not going to be a farm return. It'll be a Schedule C.
Right. Can profit loss from Schedule F, sole proprietor, be shown on 1040 if married filing jointly? Please explain what 179 and 180 are for.
Okay. Schedule F is going to be tied to the farmer. So if it's a married couple, they're filing a joint return, and the wife is the farmer and the husband goes and has a public job, then the Schedule F is going to be filed under her Social Security number. You might recall that we talked about that on Monday. Who is the farmer? And we have those identifying numbers. Okay. Then Code Section 180 is relative to soil and water conservation, fertilizer and lime deductions. The tax law says it has to be amortized, but under Code Section 180 is the annual election that can be made to deduct the full value of the fertilizer. And that's why I said 99.99999% of the time, people are making the annual election and they don't know that they're doing it. Code Section 179 is a special rule that treats that you can elect to expense up to certain levels and certain restrictions, capital assets, as long as you don't create a loss on the business. And that's why we need a depreciation webinar.
Okay, a bit more explanation about the other tax benefits of not having farm loss as mentioned at the end of the last example, except I don't know what she means by the last example. Okay.
Well, the thing, again, I have worked with people where they get their sole sustenance from farming. And I can tell you that if they have 5 years of farm losses, their creditors get nervous because they're starting to consume equity, meaning that their net worth is going down. And we've got some places in the Midwest where that is happening. If you've got a public job where both spouses are generating good income, then you really don't care about a farm loss except for the hobby loss rules that we talked about previously. As long as the land value is appreciating, as long as the whatever is being produced is appreciating either in number or in value per unit, and you can argue that with the revenue agent, then you should be in good graces. But each individual is separate. I'm trying to balance the time that I've got, and I've only got about 45 minutes left to go through another 22 slides.
Well, we are getting near the end of these questions. So how about we don't add any more questions here? I'll just get through what I have for now.
Okay.
If you start a new business with equipment previously purchased and have no receipt, how is value set for the expense? And is this equipment included in supplies?
Okay, so if you bought equipment and you used it in another business and now you're switching to farming, did you depreciate that equipment on that other business? Or are you or did you have equipment that you used for personal purposes? If you used stuff for personal purposes, then what you do is you figure out what is the fair market value of that equipment today when you put it into service for your Schedule F business. Let's use a pickup, for example. I bought a pickup and I paid $20,000 for it. It was my personal pickup. Now, 3 years later, I start farming. My pickup is worth $12,000 3 years later. It's depreciated $8,000 in the market. So since 12,000 is less than 20,000, that's going to be the amount that I'm going to start depreciating the pickup for, because that's the fair market value on the day. And if it's 100% use now for the farm, then I'm going to recover that pickup's cost over 5 years. So it'll be essentially $12,000 over 5 years per the chart. So that's how you would do it.
Okay, just a couple more. Light at the tunnel, in the tunnel here.
No worries.
Does capital improvement on a leased farm make a difference with depreciation? Is a building erected a leasehold? Oh my gosh, is a building erected a leasehold improvement or capital expense?
Yes, if you got to be real careful as to how that lease is written, but yes, that capital improvement, if you did it as the tenant, it's a leasehold improvement, and you could go ahead and depreciate it. Hopefully your lease term will be long enough that you'll get a chance to recover the cost of that building. Otherwise, if your landlord terminates the lease, then you'll have to abandon that property, and then whatever is left, you're going to recover as a cost through abandonment, but it may not have been what you intended down the road. So leasehold improvements are going to be deductible by the tenant per the allowable recovery periods, depending on what it is.
A depreciated vehicle was unexpectedly replaced by a new vehicle after only 2 years. The full value of the old vehicle was applied to the new vehicle, making it appear that the new vehicle was lesser value. How do I remove first vehicle from tax form and replace with new one without being penalized for selling the first one?
Okay, they're not going to like this answer. Okay, under Tax Cuts and Jobs Act, like-kind exchanges are no longer allowed for personal property. So what you would do is whatever the trade allowance was provided for the old vehicle, that becomes the sale price. It's a deemed sale, and you would report that on Part 3 of 4797. So bought a pickup, and we got depreciation on it. We depreciated it out. We traded the pickup after 2 years for whatever reason. We got $20,000 trade value. We're going to report that $20,000 as income on our tax return. Then we traded the value and we bought a $60,000 pickup, but we got $20,000 as trade value. So we wrote a check for $40,000. When we set the new pickup up on depreciation, we're going to take the 40 plus the 20, and that's going to be our cost in the new pickup. Once the old pickup has been sold, it's been disposed of, it just comes off of the depreciation schedule. You just remove it. And then you'll have to make the calculation as to, in my illustration, it's $20,000. It comes in, you add it to the 40, and now the new pickup has a $60,000 cost, and you're going to recover that either through Section 179 expensing or bonus depreciation or normal depreciation, whatever the choice is, but that's how that's done.
Okay, last question. I bet you can do it in 1 word, maybe 2. What category would compost fall under?
It's a cost that you could go in. It probably would go if you're buying it for as a soil amendment, you could put it in as fertilizer. If it's going in in a truck garden or whatever, or if you wanted to keep track of it, you could put it as another cost on line 32.
Okay. Thank you, Guido. You're a question answering machine. That's all the questions we have. Thank you for now.
All right, for now. All right. So let's, and we said we gave everybody fair warning. We're probably going to go over a little bit, but here we go. So lines 21A and B, this is for interest. And so we're borrowing money. Line 21A is going to be reporting interest for mortgages. So you're going to get a 1098 mortgage interest statement. So that would come from Farm Credit, would come from the bank for those kind of items, and you would tie that together. Line 21B is used to report interest paid for other sources. So if money is lent to the farming entity, such as an LLC or corporation, then a promissory note should be created with fair market terms between the individuals. And this interest is going to be deducted by the entity, and it's going to be taxable by the recipient. What I'm thinking of there is that individuals who may not want to necessarily have a capital contribution to their business, but they would rather have have a loan. That's how they would work that. So here we've got a couple of examples. Frida's got a farm loan with Farm Credit. It's for some farmland. She's paid $25,000 in interest this year. Farm Credit issues a 1098. It's going to be reported on line 21A. And this is for IRS to match that deduction against that Form 1098. And so that's relatively easy peasy. This one's a little different. Here we've got Ken. It's an LLC. It operates as a single member LLC. So remember that that's going to be kind of like a sole proprietorship. This year he paid $15,000 of interest on an operating loan. He paid $5,500 of interest on a pickup loan. Must be a really sweet ride. And then he had $27,000 of interest on machinery and cattle loans. None of these loans will report back to him on a Form 1098, because that 1098 is for mortgage interest. None of these are of that nature, but they are all business loans. So Ken LLC is going to use line 21B, as in Bravo, to report the $47,500 of interest. And I've got an error there on 21B. It should have been 47.5, but you get the point. You add all of those up and you tag it right there. Now here's another one. You got Rosita, who's got a large vegetable business. Now, one of the things that she's done is she negotiates with her lender to prepay 3 years of projected interest at a very favorable locked-in rate. She pays $45,000 worth of interest. $8,000 of interest is going to be allocable to the current year's operating loan and brings her current as of December 31 of the current year. The remaining $37,000 is going to be credited to her account as prepaid, and they're going to draft quarterly over the next 3 years. And this way, Anita in the current year is only going to be allowed to deduct $8,000 of interest on her operating loan. Now, somebody might say, well, why in the thunder did she do that? Well, because she got a very favorable interest rate. She might be paying interest now at 3%. As opposed to operating loans running at 6.5 to 7, maybe 8%. So she probably made a pretty good deal down the road. But the rule that I'm trying to illustrate here is that you can only pay and deduct. You can only deduct interest up through December 31. You can only be current. You cannot prepay interest and deduct it. And that's the example here. Here you've got another one, and this is something that some folks might want to think about. Carl has paid off the mortgage on his home. He wants to expand his farming operation and go full-time and resign at the foundry. He can borrow against his house $200,000. That's going to provide him the funds to purchase equipment and give him some operating money. And this year, his interest expense was $6,000 and is reported to him on a 1098. So Carl was able to borrow some money against his house at 3%. He makes the election to treat this interest as business interest and deduct it on Schedule F. Now, the other place, because it's against his house, remember, he could choose to deduct it as an itemized expense. The thing is at $28,000, almost a standard deduction for a married couple, that may not be a good decision, but because he did it this way, he got a favorable interest rate, and he got a $6,000 making the election to do this as business income. And then it's not only a deduction against income tax, but it's also a deduction against self-employment tax. So this has been a strategy that's been used by some folks that have been bootstrapping some of their farming operations. Labor is line 22 as we carry on. And it's just very simple. This is where we deduct our labor that we pay. This is our W-2 wages that we're doing. Tomas hires 2 employees. He pays them 30 grand each. So he reports 60,000 right there on line 22. Pretty much straightforward. Now here we've got Carla, who has 5 part-time employees. She's paid them an average of 10,000 each. So there's $50,000 in cash wages, but she is also eligible for the work opportunity credit of $2,000 on 2 of her employees. And she has $3,000 of the employer credit for paid family and medical leave that's available. So she is going to receive a tax benefit, these 2 credits. And by the rule, she has to reduce her cash wages by these 2 credit amounts. So instead of $50,000, she's going to get $45,000 of deductible labor expense, but she gets those credits. So it's a little bit there. It's a little bit of a paperwork, but that's just an illustration how some of those employment credits work. Pensions and profit sharing, probably not very applicable to most of the folks on this call, but just because it's a line number, you just see you got $25,000 in this particular example contributing to their matching contribution in the retirement plan. And again, this would be looking at, hey, how do I compete to get good help? And I'll just leave it to that. I think it's relatively straightforward on that one. You just use line 23 for pension and profit sharing. And here's a big one that we have, and this is rents. So farmers and ranchers, they do rent land. Sometimes they'll lease equipment and they'll get breeding animals, and they do that in order to grow their business and increase their scale. The expenses are going to be deducted on lines 24A or 24B. So in this example here on this particular slide, Antonin farms 1,500 acres. He's got 1,000 acres of from 3 landlords, and 500 acres then is going to be owned. Now he pays an average of $235 an acre rent. And so on line 24 Bravo, you're going to see that the rent or lease, and this is for land and animals, that's going to be $235,000 that he has paid out. And he's going to issue 3 IRS Form 1099 miscellaneous to each of his landlords, one for $100,000 and a second for $67,500 and the third one for $67,500. The point here is anything over $600 for rent, he's going to have to issue that 1099 miscellaneous, and IRS is going to match the rental 1099s. Now here's another one. You got Isabella, and this may be more applicable to some of the folks on the call. So Isabella rents a backhoe to dig out the water line. Now she rents it from ABC Inc. and she pays $75 an engine hour. Now her employee, Robert, operates the machine, and when he's finished with that particular job, the hour meter has showed 10 hours of engine time that was consumed by Isabella. So she's going to write a check for $750 to ABC Equipment Inc. And she's going to report and deduct that rent, as you can see there on line 24A. But she doesn't have to issue a 1099 miscellaneous because ABC Equipment is incorporated. It's a little bit nuanced different from the previous 2 examples. Now, what happens if you've got land and machinery being rented together? And sometimes this happens when we have farm transition, depends. And in this case, we've got Grandpa Joe who rents his farm and equipment to his granddaughter, Emily. And the land and the equipment are going to be rented together because Emily is a beginning farmer and she needs the equipment to operate. And additionally, as part of the rental agreement, Grandpa Joe wants to have the land maintained in such a way. And some of y'all might have grandpas that you can say, yep, I know exactly what he's talking about. Now, she can keep her Grandpa Joe's land as he wants. Emily pays him $65,000 for the land and the equipment as a lump sum. The rental arrangement is such that it's $40,000 for the land and $25,000 for the machinery. And she would report these two items on lines 24A and 24B, as you can see listed there. So the machinery rent's $25,000 and the land rent's $40,000. But she's going to issue one Form 1099 miscellaneous for $65,000 to Grandpa Joe. And remember, she's got to tick the questions F and G in the affirmative that we talked about on Monday evening. Now, we need to think through a little bit because I think with interest rates increasing and possibly the loss of bonus depreciation, we're going to see some machinery rentals come back into vogue. And here we've got Gerald entering a 3-year operational lease for a new tractor with PDQ Leasing Partnership. The terms of the lease are such that at the end of the lease, Gerald has to return the tractor to the leasing company. The leasing allows for 500 hours of engine time, so 1,500 hours in total at a cost of $50 per hour. If he uses it more than 1,500 hours, he's going to pay $85 an hour for the overage. And he's required to cover the insurance, the maintenance, and the repair costs, however, are going to be covered by the leasing company. And in this particular year, he pays $25,000 to lease the tractor. He's got to issue a 1099 miscellaneous to PDQ Leasing because it's a partnership and it's not a corporation. So it's an unincorporated business. And we're going to use line 24A to report and deduct that true operational lease. Now, the next one is where we get, from a tax practitioner standpoint, I've had a little bit of heartburn about this. Bernadette enters into a 3-year lease for a combine. The lease agreement requires paying $175,000 each year and then provides the option to purchase a 3-year-old combine for $15,000 at the end of the lease. She's required to insure, maintain, and repair the combine over the lease term. And because of the construction of the lease and a very low price at the end of the lease, this lease is a capital lease, even though that's what they might say. It's going to be treated as a combine purchase, and it should be depreciated over 5 years, not 3. It was brand new. And so I've had to deal with this a time or two. Is maybe an over-the-top example for some of the folks on the call, but it just illustrates the principle. The first one is an operational lease. The second one is a capital lease. And because it's a capital lease, it should be treated as if it was a purchase and be depreciated appropriately. Questions at this point?
I think I only see one. Whoa. So if y'all have questions, put them in. My farmland and home are on the same loan with Farm Credit. I was under the assumption I could not use my mortgage as a farm expense. Please clarify.
Okay. So what you've got is you've got farmland, which is going to be a business asset, and your principal residence, which is going to be a personal asset. And so depending on how you wanted to do that, you could bifurcate the loan when you purchased it. So if your house was 300,000 and the land value was 200,000, then 40% of the interest is going to be deductible against the farm, and 60% of the interest is going to be deductible against the house. And the tax rule assumes that you're going to pay the house off first. Whether you do or not, the tax rule assumes that you pay the house off first for 300,000. Once the 300,000 is paid off, then 100% of the interest is going to be deemed to be farm business interest. It's a little bit of a complicated rule, but that's how that works.
Okay. That's it. Questions, Guido? I mean, you know, nothing wrong with that. We had so many the last time.
That's fine. And we've got one more towards the end, and it looks like we're going to make it, Debbie.
Okay, great. Thanks.
All right. So here's one looking at repairs and maintenance. And depending, when you look at it from a percentage, regardless of scale, repairs can be a large total item. And repairs that are costly need to be examined to see if they ought to be capitalized under the repair regs. And if the expense which is incurred leads to a betterment or an improvement of the asset, then that cost needs to be capitalized. If the expense is a restoration of the asset to continue into service, then the cost should be capitalized. And examples are going to be replacement of major components, such as rebuilding an engine, or maybe rebuilding a transmission after, a long period of use. If the expense adapts or changes the use or the purpose of the asset, then that expense should be capitalized. And the example there is adding walls in an open barn's interior to create a birthing area for cattle or a sick pen. And I'm not as green as I am cabbage looking. More than likely, that's going to be written off as a repair. But I'm just telling you that's what the rules say. So we're going to go through some examples. So Bob performs routine maintenance on all his tractors and combines and heavy trucks. And he spent $10,000 on all of that. And that's just going to be repair and maintenance on line 25 as illustrated on this particular slide. Now, here we've got one, and I'm just illustrating this one. So Armando has bought an old set of grain bins and scales that are adjacent to his farm. But before he could use them, he has to replace all the roof panels, and the scales have to have new damper arms in there so that the trucks aren't going to override the weigh arms. And he ends up spending $45,000 on the grain bins and scales to get them back into service. This is an example of restoration. The assets are being restored to serviceable condition before they can be placed into service. So in this case, he's going to have to capitalize the $45,000, add it to basis of the grain bins and the scales, but then he's going to be able to depreciate those and make the various depreciation decisions relative to those unique assets that he's acquired and what his needs are. So he may be able to write it all off and as an expense election, or he may say, no, I'm going to take it and just depreciate these over 7 years. Now here's Theodore. He operates a large crop farm. During tillage and planting, one of Theodore's tractors malfunctioned. The gauge did, it overheated, and the engine seized. And Theodore spent $25,000 replacing the engine and returned the 5-year-old tractor into service. Now, in this particular case, there could be two arguments. One is that this is a repair which occurred just outside the manufacturer's warranty, but before the tractor was fully depreciated over its 7-year recovery period. Now, the value of the tractor was $150,000, so it was not greatly enhanced with the replacement of the engine, as the tractor's value returned only a 3% marginally higher value. So the engine replacement was 16.67% of the tractor's value. he could probably deduct it as a repair on Schedule F without any problem. A more conservative position is that this is a betterment and capitalize that new engine's cost and then use the expense election to recover it. Both will get you to the same place. There's a couple of little hoops to hop through. Should the return be reviewed, the second option probably would make the auditor smile. Line 29, as we're coming into the home stretch here, this is taxes. Now, these are going to be used to report the various taxes that are paid on these obligations of the farm business. And they're just listed here as just items. So it could be Social Security and Medicare taxes that the farmer or rancher pays to match withholdings on the employee's wages. If there's sufficient employees out there and the total wages in a quarter exceed $20,000, then federal unemployment tax is going to be due. If you've got some heavy trucks, federal highway use tax is going to be due. State unemployment fund contributions, if they are required, they're going to be there. Property tax on farmland used in the trade or business of farming, that's probably the more common one for the folks on the call. And if there's any property tax on farm machinery, livestock, or vehicles, subject to such tax, and that would be your property tax on your pickups, more than likely. That's where you're going to deduct them on line 29, Schedule F. So here you've got Louisa. She's got 2 employees. As an employer, she matches the withholdings from her employees. That happens to be a total of $7,500. She also pays $8,500 in real estate tax and $3,500 on her farm machinery and vehicles in her particular state. If I've done my math right, that's $19,500 in the current year. It's those 3 items put together, and she would just report those all, as you can see illustrated there on line 29 of due to that. Now, I'm just assuming here she's exempt from federal and state unemployment tax because she doesn't meet the threshold with the number of employees or wages per quarter. Taxes which are not a business deduction, and there's some folks that try this one every once in a while. Federal income taxes, and that includes self-employment tax. Remember that self-employed farmers get to deduct half of their self-employment tax on Schedule 1 of Form 1040. You don't do it on Schedule F. Property taxes on the principal residence and personal property not used in the business. They may be eligible as an itemized deduction on Schedule A, but they're not going to be a business deduction. Taxes assessed for improvements such as road improvements or sewers and their locality. State and local sales taxes on items purchased for farming businesses. Generally, the sales and use taxes are added to the cost of the property, and if then depreciable, they're going to be recovered over the allowed period. And then any other taxes that are not related to any farming business. So that's kind of a quick and dirty list. Utilities, you got those that we got for gas and electricity and those kind of things. Here we've got the example that Billy operates a farm, has a landline, one of those very few people that still has a landline, goes to his farm home, which he shares with his wife, Millie. The base rate's $15 a month. He averages a phone bill of $150 a month, of which 75 are business calls. So he's going to be able to deduct $75 a month times 12, which is $900 against his farm income. And he's going to use line 30 there. With cell phones, this is not going to be as applicable because one could be the farm phone, the other could be the family phone, and that's the way that I handle it. My cell phone is we do not have a landline here at home. My wife has her own cell phone. I have my own cell phone, and every child has a cell phone. But fortunately, we're empty nesters as of January 3rd. So The farm phone is my phone or the business phone in my case, and we have another phone, and that's where I feel fairly comfortable with that. And here's just a splitting of farm utilities versus personal. And this may be applicable if we're living in a rural area. It depends on what is coming as a utility to the home. Here we've got Jose and Rosa operating a crop farm and livestock. They use the propane to heat the house and livestock barns, but there are unique propane tanks for each building, and the building is separated between the home and the farm. So that's easy peasy. They have a single meter that runs for each water and electricity. It runs to the house and then to the farm buildings and livestock tanks. And based on utility company estimates, Jose and Rosa allocate $100 a month for personal electricity and $75 a month for water. And the remaining balance of those go to farm utilities. So this year they paid $6,000 for electricity, $4,500 for water. So $4,800 is farm business, $3,600 is for watering livestock. And we're just going to report all of that as $8,400 as a utility expense on the farm on line 30. Farm expenses that don't fit any categories, they're going to be deducted on line 32. We've talked about some of those. Here's just some illustrations. We've got professional fees, office supplies, and I've got a home office deduction. I'm using 200 square feet of a room that's exclusively used as the farm office. We're going to use the safe harbor at $5 a square foot, as you can see listed there on the screen. And so we've got separate little line items, $25, $150, and $1,000, just to keep track of those, and they all get totaled up. Startup expenses, we've talked a little bit about that previously, but this is how those startup expenses would be deducted. So in this case, Debbie began her own pick your own berry farm on land that she inherited from her parents, and it had mature berry plants. Since this is a new business, it's a new business to Debbie. Debbie calculates her startup expenses and deducts them subject to the rule limitations. So she's got $20,000 in allocable startup, $5,000 of which she can deduct currently. She has to amortize the remaining $15,000 over 180 months or 15 years, crazy. And so she's going to get a total deduction of $6,000, as you can see there. And we'd list those as startup expenses. She would get $6,000 this year in 2023, and then in 2024 and the subsequent 14 years, she'd get $1,000 as a deduction. So wrapping up, I didn't think we're almost there, Debbie. We're doing well. Line 33 is the summation then of all of our expenses from lines 10 through 32F. Now in this example, we totaled that up. Georgia's got $652,435, and she just puts that there. As you can see there, if it's a loss, if 24F is negative, we've got to see the instructions, but basically that, and there's a very rare case when that would happen. So there's our 652 total expense. Now we want to calculate what our profit or loss is. That's going to be on line 34. So here we've got Alfred. He reports $895,345 on his Schedule F, line 9. So that's at the top. Remember, that's gross farm income. Then he's got total expenses on line 33 of $767,000 and some coin. If I've done my math right, he's got a net farm profit of $127,783. Big numbers. Probably folks are looking at that and saying, yeah, I wish maybe I need to knock off, and go 89,000, 76,000, 12,000. That's more realistic. But I think the point there is we're down here at net farm profit. That net farm profit is going to be subject to ordinary income tax, and it's also going to be subject to self-employment tax. One of the things we do have to watch out for at the bottom is that if we have a loss, and in this example, we've got Susanna, her loss is $135,000 is illustrated there because she's got more expenses than she does because of whatever in the story, she's got a spring freeze. The issue is we need to go down the line 36 and check the box that all the investment is at risk. Meaning that either she's got all the money in it and she's at risk for it, or she has recourse loans, meaning that if something goes south, the bank's going to come and take it, whatever those assets that were held as collateral. If it's a non-recourse loan, and I don't know of any bank that would do a non-recourse loan, then you would tick number B, some investment is not at risk, and then you've got a calculation to make as to how much of this loss you can use against other income. So just in summary, what we've just gone through, we've got cash basis Schedule F. We're going to respond to the details in the information block, and we're going to answer the questions A through G, like we talked about on Monday evening. The farm income, it's going to be correctly and accurately reported on lines 1A through line 8 of part 1. And then we're going to calculate gross farm income, which is going to be the summation of lines 1C through 8 on that line. And then whatever our allowable farm expenses are going to be, they're accurately and correctly reported on lines 10 through 32F. And then finally, we're going to calculate, once we've got all that done, we're going to calculate our net farm profit or loss, however derived on that, on line 34. And we would just be reminded that if we're showing a loss, then we have to answer that applicable question that it's either at risk or partially at risk on line 36. So we got, Jebby and I sometimes get asked questions. Well, how do I keep records? Well, there's manual systems that work, notebooks and ledgers that they still work. You could do, if you're real good at driving a spreadsheet, you could use, for example, Excel, and you can create that spreadsheet to match your own business. Because you know your business, you could use software like Quicken or QuickBooks or FarmBooks. The issue is you got to be comfortable with the method, or you're not going to use it. And some folks wait until the very end of the year, and they do the last week of the year, they do all of their accounting because that works for them. It's not necessarily the way my brain works per se. But if it works and they're consistent and they're making money, I can't knock it. So Debbie, that gets us, we've got 3 minutes left. And this is a really pretty picture. I wished I could have taken it, but this is of a North Carolina farm up in the mountains.
Thank you, Guido. We do have a few questions, and if, we'd already said we could run a little over, so if people are willing to stay, we can stay a little bit late. When you were talking about repairs, does that include computer repairs?
If that computer is for farm record keeping and for, business purposes utilized at the farm, yes.
Okay. For line 29 on taxes, I have a personal truck and my log shows 95% of miles are used for the farm. Does that mean I apply 95% of my annual tax on my Schedule F?
Yes. So you got that log, 95% of your property taxes that you would pay are going to be able to be deducted there, and 95% of your registration fee.
What is not considered a startup expense?
Ay, ay, ay. So what really defines what a startup expense is that point in time when one can look at it and say the farm or the business has begun to operate and perform the services or grow the crops for which it was organized. All of those expenses prior to that time, prior to that date are going to be startup expenses. And after that date is going to be ordinary and necessary expenses under that you can take under Code Section 162.
Okay.
There is a little there on ruraltax.org. There's an article there that discusses startup expenses, and I think it and ruraltax.org is one of the resources that Debbie has listed on that resource site. I would just encourage you to go read that article.
Okay. I asked the earlier depreciation question about buying a business and depreciating the down payment and my 2023 loan payments for assets and customer list. Would it be more appropriate to deduct $5,000 as startup cost?
If your business hasn't started, then yes. But if you've actually started, I mean, if you bought an existing business and the name changed, then and it basically was just a change in ownership, then your business started the day that you signed the contract and turned over the money.
Okay. I heard somewhere that a landline is needed in order to claim home office expense. Is this incorrect?
I claim the home office expense. I'm standing in my home office. I deduct it. I do not have a landline. I've got a cell phone. I think the reality is that Treasury regulations have not kept up with the reality of 2024.
Okay. If I have paid myself as the manager owner of my LLC, is that considered profit even if my business did not post a profit last year due to lots of startup costs?
No, depends on how you're organized. If you're a single member LLC, not incorporated, then what you've taken is a draw. And if your business did not show a profit and your draw was in excess of whatever the business took, then you have reduced your capital position in your business. Essentially, you've lived on borrowed money.
Okay. I think this is the last question. No, a couple more questions. Can you link or direct? Oh, okay. Can you link or direct tax workshops on agritourism Schedule C via email after this workshop? I'm reading these as just right now. I've been taking a percentage of Schedule F expenses and applying to Schedule C instead as per my accountant's recommendation. Does that overall sound correct to do?
Well, it sounds like the accountant is trying to allocate between two businesses, the Schedule F farming business and the Schedule C ag tourism business. And it sounds, based on the question, it sounds reasonable to me.
And I don't quite understand the first part of that question. I know there's currently a agritourism conference right now. If you're asking about additional tax workshops, the only ones I know of are the ones that we're doing. So just follow up with me afterwards, please. This is the last question that I see. Perhaps I missed it, but I don't remember hearing anything about a business personal property listing form that must be filed each January. I believe this tax would be placed on line 29. Am I correct? This includes taxes on machinery, computer office equipment, and farm equipment. I was unaware that this was required by NC Department of Revenue until recently, and I thought others might like to learn about it because it's required by the Department of Revenue.
You're correct. It's a property tax issue. It's not an income tax issue, but any property tax that is generated because of that, those assets that are listed would be deducted on the tax line on the Schedule F.
All right, so thank you so much, everyone, for attending. And like I said, I'll send out a follow-up email. Many thanks to Guido. He will be doing some additional workshop or webinars, like I said, later in the year. We hope you all will take the time to fill out the evaluation. We hope to see you at additional programs later.